By now, you all know about the process of accounting, wherein we identify the financial transactions, record them in the journal, and post it into the ledger. Now, ledger gives the balances of different accounts. Now, these steps continue during the financial year. And in between this process, bank book is reconciled with the cash book, errors are traced and rectified, and the trial balance is also prepared to know the arithmetical accuracy. Now, before moving to the next year, the firm needs to know the results. So at the end of the financial year, we prepare a summary of the transactions which took place during the year. Summarizing is the process of preparing the financial statements which help a firm and the other stakeholders to plan and take important decisions. Dear learners, this is Shashi Ramachandran, and in this video we'll learn about the financial statements, and after watching this video you will be able to understand the meaning and the relevance of financial statements, what financial statement consists of, also the classification of expenditure. So at the end of the financial year, company wants to know whether they have earned a profit or suffered a loss. So final accounts of the firm displays the net result for the given year. This is just like the result you get at the end of each session before you are promoted to the next class. So information provided by the financial statement is used by the stakeholders of the company like management, investors, creditors, employees, government, etc. Because financial statement is something which is published in the newspaper or a magazines or in a website which stakeholders can review and can take the important decisions. So now let's understand that this financial statement, what it consists of. Now the financial statement consists of these three major statements, that is income statement, position statement, and a cash flow statement. Coming to the first one, income statement, which is also known as profit and loss statement. Now this statement primarily focuses on the company's revenues and expenses during a particular period. Now the income statement is the one we can say the company's core financial statement, which shows the profits earned and the loss suffered by the firm over a period of time. So here the period is taken as a one financial year, and in this the profit and loss basically is determined by taking all the revenues and subtracting all expenses from both operating and non-operating activities. So the main purpose here of income statement is to convey the details of profitability and business activity. So here mainly it is related with the profitability. So it conveys the detail of profitability and the business activities of the company to the stakeholders. Now people pay attention to the profitability of the company for different reasons. So why profitable? Why they want it? For example, if a company was not able to operate profitably, a banker, a lender, or a creditor may be hesitant to extend additional credit to the company. On the other hand, if the company that has operated profitably has shown its ability to use the borrowed and invested funds in a successful manner. So here profitability is directly related to how the performance of a company is. It is related with the performance of a company. So this profit income statement gives us a picture of gross profit and net profit. Coming to the next thing, that is position statement, also known as balance sheet reports of a company's assets, liabilities, and shareholders' equity at a specific point of time, and that provides a basis for computing the rate of return and evaluating the capital structure. So you can see here it says as at. So it is at a point of time wherein you have all these liabilities, including the owner's fund, also the funds raised from outsiders, and this side shows the investment of these funds in different types of assets. So it is a financial statement which provides the snapshot of what the company owns and owes. So as well as the amount invested by the shareholders or the proprietor. So it is a picture that what funds are invested into the business and how these are allocated in different assets. Coming to the third one, that is a cash flow statement. This measures how well a company generates the cash to pay its debt obligations. It is a statement which gives a picture of inflow of cash and outflow of cash. So cash inflow and cash outflow. So this cash flow statement complements the balance sheet, that is a position statement, and the income statement. Now about this cash flow statement, you are going to learn this in your next class, that is class 12th. You will be learning about cash flow statement in detail. Now in this class you are going to learn about these two, that is income statement and position statement. So income statement, which is trading and profit and loss account, and it shows the financial performance in the form of profit earned or the loss suffered by the business. On the other hand, the position statement is a balance sheet which tells the financial position in the form of assets, liabilities and capital. Now one more important thing to understand, these two statements are prepared based on the trial balance. So trial balance, which you all know, it's a list of all the balances from the different ledger you have taken out. You have prepared the list of all the accounts with their balances and some additional information which actually you get at the end of the year, the day when you prepare the financial statement. With these information and the trial balance, you prepare your final accounts or the financial statements. Now this distinction, capital and revenue items, the distinction has very important implications for making of trading profit and loss account and the balance sheet. So before preparation of trading profit and loss account and the balance sheet, you should also understand the difference between these capital and revenue items. You should be able to distinguish the two, because in a trial balance you are given with different expenses, income, all the accounts are mentioned here with the amount, debit and credit. So here this includes both capital and the revenue items. The revenue items form the part of the trading and profit and loss account. The capital items helps in preparation of balance sheet. So you can see that from the trial balance the amount is transferred to trading P&L account, that is revenue nature items are transferred to trading profit and loss account, and capital nature is transferred to balance sheet. I've already prepared a video on these capital and revenue items, so I'll give the link in the description box. Do check out my previous video to get a detailed explanation of these items. But here I'm just giving you a recap of that: revenue expenditure, capital expenditure, revenue receipts and the capital receipts. So expenditure are divided into two, that is revenue and capital expenditure. Revenue expenditure is the one which extends up to 1 year. That means the benefit of the revenue expenditure, the benefit what we get from the such type of expenditure is exhausted within a year. So we can say that, for example, wages are paid. So this is an expenditure. This is an amount which is spent. Now here the benefit, the services which we get from the labor or the worker is exhausted within a year. Majorly what happens, like we take a services and then we pay the wages. So that means benefits we have already taken the benefits. The benefits are already exhausted. So such expenditure, such payments where the benefits are already exhausted or they can exhaust within a year, such are called as revenue expenditure. And coming to the next one, that is capital expenditure. Here the benefit extends more than one accounting period. That means whenever you are spending, say you spend on purchasing a furniture or buying a machinery or some advance money you have paid. So here for all these payments, the benefits are still to be availed. So such expenditures are called capital expenditure. Same way, the receipts also are divided into two categories, that is revenue receipts and capital receipt. So revenue receipts, normal or a regular course of business receipts, or we can say that these are regular in nature, these are operating in nature, these are recurring in nature by selling the goods or rendering the services to the customers. So here like we also can say that revenue receipts increases the profits. It increases the profits. It doesn't have any effect on the liabilities or assets. Neither it increases the liabilities or decreases the asset, or we can say that it has no effect on the liabilities and assets. Rather it is only related with the earning profits. So sale of goods, it generates the revenue, it increases the profits of the business. So that is revenue receipt. On the other hand, the capital receipts are the one which are irregular in nature. They are not recurring in nature. Once in a while you get such receipts. So they are not directly affecting your profit and loss. They do not affect your profit and loss. Rather, it decreases the asset or increases the liability. So either it increases the liabilities or it decreases the assets. That means I can take an example like raising of loan. Raising of loan, here it's a receipt. You're receiving a money, but it increases the liability, not the profits. Same way, the sale of assets will decrease the value of the assets, but doesn't, again, sale of asset is a receipt. You receive a money, receive the cash here. Okay, but it decreases the value of the asset. It will not increase or affect your profit or loss. So such receipts are called as a capital receipts. So these are different items like capital items and the revenue items. And now let's understand where they are placed. So capital expenditure, as we know, the benefit extends more than 1 year, so it becomes a part of a balance sheet and shown as an asset in the balance sheet. On the other hand, revenue expenditure, where the benefit exhaust does not extend to the next year, these expenses are shown in a trading profit and loss account. And coming to the capital receipt, which are not recurring in nature, so these are shown as a liability because it affects only the liability and the fixed assets. Liability increases or the fixed asset reduces, so it is shown in the balance sheet. And revenue receipt has a direct impact on the profit and loss, so it is shown in the income statement, or we can say trading profit and loss account. Okay, so these are the one: capital expenditure, revenue, capital receipts, revenue receipts. So the distinction of these expenditures or these items, capital and revenue, should be very much clear to you. There is one more called as a deferred revenue expenditure. Now coming to this deferred revenue expenditure. Now deferred revenue expenditure is a revenue expenditure. By nature, it is a revenue expenditure which is incurred during the period of accounting period. But its benefit is likely to be derived over a number of years. So we can say that it is revenue in nature because you have paid the money for that, but the benefit you are going to get, like you can easily spread the expenditure to a number of years. Why? Because of the benefit which you are going to derive from it is over the number of years. For example, huge expenditure incurred on advertisement campaign of a new product. So product launching campaign, if you have spent a huge amount on this product launch campaign, you can divide this amount. Instead of showing the entire expense or that huge amount in 1 year, it is not actually shown in 1 year in your profit and loss, rather it is spreaded over number of years, and the part which is written off, which is like divided 1 year part, the written off part in the current year is actually debited to profit and loss account, and the unabsorbed or the one which is not written off is shown in the asset side of the balance sheet. So this is what deferred revenue expenditure. Okay, so it's very important that you should understand the capital and revenue nature expenditure or receipts, same way deferred revenue expenditure, to understand more about income statement and position statement. You will be able to prepare your income statement and position statement only once you understand the nature of different items. So let's recap. Financial statements, these are the summarized statement of accounting data which provides the information about the profitability and financial position of a business concern. So it consists of income statement, position statement, or also the cash flow statement. But as I said, cash flow statement is not in class 11th. You are going to learn more about cash flow statement in your class 12th. So income statement, which shows the profitability of the business, and income statement we prepare trading profit and loss account, which shows the profitability or the financial performance, profitability of the business, that is profit earned or loss suffered. And here in the trading account, the nature, we also learned that what type of items are shown in trading profit and loss account, that is revenue items. On the other hand, balance sheet is prepared under position statement, which shows the financial position of the business, and this record all capital items given in the trial balance. So in a next video, we'll be understanding about these two statements, income statement and position statement. And I hope you like this video. Share this video with your friends and do subscribe to my channel Exuberant Learners. Also click the bell icon to get the latest update on my channel. Thank you so much.